Welcome to today's video. You've rebuilt your savings, and you might feel tempted to jump into real estate. However, before making a big move, we need to place security and tax optimization ahead of speculation. This video will lay out why your $20,000 is a non-negotiable emergency fund, and how a disciplined investment hierarchy can build wealth faster and safer than premature property purchases. Let's begin by laying out our roadmap. Here's the agenda. First, we'll face the cold, hard truth. Next, we'll cover a brief but important disclaimer. Then we'll set your emergency fund correctly, walk through the investment hierarchy, and map a clear action plan. After that, we'll expose the property trap and review key numbers. We'll also test your understanding with a quick quiz, explore tax wins, and show a decision flowchart. Finally, we'll give you a concise markdown cheat sheet, summarize the key takeaways, and wrap up with next steps. The cold, hard truth is simple. Security beats speculation, especially at this stage. Your $20,000 is not a down payment. It is your emergency fund. It protects you from job loss, medical bills, and unexpected expenses. It must be safe, easily accessible, and dedicated to stability, not growth. We will treat this money as non-negotiable and place it in a high-yield savings account where it can earn modest interest while preserving liquidity. Before we continue, a quick disclaimer. This video is for educational purposes only and is not individualized financial advice. Your situation may differ, and your risk tolerance may be unique. Please consult a qualified fiduciary financial advisor and a tax professional who can consider your full financial picture before implementing any strategies discussed here. With that in mind, let's move forward. Your $20,000 serves as your emergency fund. First, keep it in a high-yield savings account to combine safety with modest interest. Second, your target size is 3 to 6 months of essential expenses. If your monthly essentials are $3,000, then $9,000 to $18,000 is your minimum band. The full $20,000 gives extra resilience. Third, automate transfers to maintain this buffer. Fourth, name the account clearly as emergency only to avoid casual spending. Finally, if you need to use it, replenish it right away. With the emergency fund secured, we can turn to the investment hierarchy that accelerates long-term wealth. Follow this sequence. First, confirm your emergency fund target, generally 3 to 6 months of essentials. Next, eliminate high-interest consumer debt, typically above 8% annual percentage rate, because this is a guaranteed drag on wealth. Then, contribute to your 401k at least up to the full employer match to capture risk-free returns. After that, maximize your IRA, either traditional or Roth depending on eligibility and tax considerations. Subsequently, raise your total retirement savings to 15% or more of gross income. Once those bases are covered, add taxable investing for flexibility and liquidity. Only after you have completed these steps should you begin saving for property, with a separate down payment and 6 to 12 months of property-specific reserves. This mind map organizes priorities. Start with security, a fully funded emergency fund, and appropriate insurance coverage. Next, optimize taxes through accounts like a 401k, IRA, and possibly a health savings account if eligible. Then focus on diversified, low-cost index fund investing to capture market returns efficiently. Only after these foundations are solid should you approach property, aiming for a 20% down payment, ample cash reserves specifically for the property, and an understanding of closing costs and capital expenditures. Let's compare the two paths. Buying property now often drains cash upfront. It ties you to an illiquid asset and exposes you to local market volatility. You also inherit ongoing costs such as property taxes, insurance, maintenance, potential vacancies, and surprise repairs, which reduce your margin for error and diversification. In contrast, prioritizing retirement accounts first allows you to capture employer matches, harness tax advantages, and compound for decades with broad diversification and lower fees. Moreover, it preserves liquidity and creates a stronger base before you take on an illiquid, capital-intensive investment. To anchor the numbers, at $80,000 of income, 15% is $12,000 per year, or $1,000 per month. At $100,000, that's $15,000 per year, or $1,250 per month. At $120,000, it's $18,000 per year, or $1,500 per month. For your emergency fund, if your essential monthly expenses are $3,000, $4,000, or $5,000, then your 3 to 6 month targets are $9,000 to $18,000, $12,000 to $24,000, or $15,000 to $30,000 respectively. These are the ranges you should use to calibrate your safety net before committing to property. Property ownership often includes hidden or underestimated costs. You can expect closing costs of 2 to 5% of the purchase price, inspection, appraisals, and title fees, and ongoing maintenance of roughly 1 to 2% of the home's value annually. In addition, you must budget for property taxes and insurance. Capital expenditures such as roof replacement, HVAC, and plumbing are irregular but large. Vacancy risk and cash flow shocks can occur if you rent the property. If you put less than 20% down, private mortgage insurance increases your monthly outlay. These factors make property a high capital, high commitment move that should come after your financial base is solid. Quiz time. Which comes first before saving for a property down payment? Option A. Maximizing retirement contributions to at least 15% and capturing the 401k match. Option B. Buying as soon as you have $20,000 saved. Option C. Skipping the emergency fund to invest more. Option D. Putting all available cash into the property fund. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is Option A. Prioritizing retirement contributions, especially capturing the employer match, and raising contributions to at least 15% of gross income, generally leads to stronger long-term outcomes than moving into an illiquid property too early. Here's a simple allocation concept. First, secure the full 401k employer match. Next, maximize your IRA depending on your eligibility and tax status. If you're eligible for a health savings account, consider using it for its triple tax advantage. Only after these priorities are funded should you begin a separate property fund. This order optimizes taxes, compounding, and flexibility. Second quick quiz. What is the primary purpose of your $20,000 right now? Option A. Speculating on a quick home purchase. Option B. An emergency fund for safety and liquidity. Option C. A down payment for immediate real estate. Option D. High-risk investments for maximum returns. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is Option B. The $20,000 is your emergency fund. It protects your stability and provides immediate liquidity when unexpected events occur. Its goal is resilience, not aggressive returns. This decision flow guides you logically. First, confirm that you have 3 to 6 months in an emergency fund. If not, build that foundation. If yes, ensure you are contributing to your 401k, at least up to the employer match. Next, verify that you have maximized your IRA and raised total retirement savings to at least 15%. If any of these are incomplete, return to the respective step. Then, eliminate high-interest debt. Finally, ask whether you have a full 20% down payment and 6 to 12 months of property-specific reserves. If the answer is no, continue saving. If the answer is yes, only then consider a property purchase, performing thorough due diligence and stress testing the numbers. Here is a concise markdown cheat sheet you can save. First, the one-page plan lists your emergency fund, 401k to the full match, IRA max, total retirement at 15% or more, optional taxable investing, and property only with a 20% down payment and 6 to 12 months of reserves. Next, the stress test checklist asks whether you can afford principal, interest, taxes, and insurance with a 2% higher rate, whether reserves cover 6 to 12 months including capital expenditures, whether a 3-month vacancy or job loss is survivable, and whether your rent and repair assumptions are conservative. Finally, the quick targets include eliminating debts above 8%, choosing low-cost, broadly diversified index funds, and automating contributions. Let's cement the takeaways. Your $20,000 is a protective fortress, not a down payment. Maximize tax-advantaged accounts before committing to an illiquid property. Eliminate high-interest debt to prevent guaranteed losses. Approach property only when you have a substantial down payment and dedicated reserves. Above all, follow the proven flow: security, then tax optimization, then diversified growth, and finally property. To wrap up, secure your emergency fund in a high-yield savings account at 3 to 6 months of essential expenses. Contribute to your 401k up to the match, and then maximize your IRA. Raise total retirement savings to at least 15%. And consider taxable investing only after these steps. Avoid the property trap until you are fully capitalized with a strong down payment and reserves. Use the decision flow and stress tests to stay disciplined. Next, set up your automation and calendar reminders to keep the plan on track. Thanks for watching. If this video helped you, please like it, share it with a friend, and subscribe for more practical, data-driven money strategies. In the comments, tell us your next step and any questions you want us to cover in a future video.